Hello everyone and welcome to the first part of chapter number 3. The name of this chapter is Financial Markets, Money Markets and Institutions, and the reason why we are studying this chapter in financial management is because financial managers should have a strong understanding of the financial markets so that in the time of need they can take strong decisions, they can take informed decisions from where to raise finance, and if they have surplus of funds, they should know where to invest it. So with that in mind, let's start with our chapter. If you come to the page number 23 of your lecture notes, we have our first topic over here, that is financial intermediaries. Now, financial intermediaries basically links those with fund surplus to those with funds deficit, so that they can avail the opportunities they have by utilizing those funds and benefiting the provider of finance as well. This results in basically the economies of scale in terms of finance, in terms of money, and also risk pooling and maturity of transformation. Now, it is best understood if I can put that in a chart. I've already drawn a couple of houses. The best form and the most simple form of financial intermediary is a bank. Here we have got a bank in the center. So what a bank does is basically takes funds from households and companies. Households involves people like you and me who save money from our salaries and or income and give it to the bank or deposit it in a bank to earn a nominal interest over it. And companies also do the same. When they have surplus funds, they tend to put it in a bank or deposit it in a term deposit so that they can get the benefit of putting their funds in the bank. And what bank does is give those funds by pooling together those funds. It creates a large fund and gives it to the companies which are in dire need of those funds. Now, here what a bank is actually doing is taking funds from the household and companies who have the surplus funds but do not have the opportunities to invest those funds, and giving it to the companies who actually have the opportunity to invest or to grow their businesses. However, they lack finance to do that. Now, bank will always charge the company to the companies a higher interest rate to against the interest rate which it is offering to the household and company that is its own provider of finance. There are a number of benefits for this. The risk is pooled together in a single fund, so that even if the debt holder is defaulted or is unable to pay for the debt, the household and companies will not get affected by it. Moving on to our next area that we have is financial examples of financial intermediaries. And the first is commercial banks. Now, banks, what they do is, as I've just told you, they take funds from the household and companies and give it to the businesses and companies that are in dire need of those funds so that they can expand their businesses. Then we've got financial houses. Financial houses mostly involve brokerage houses. What they do is they persuade businesses, banks, and individuals to invest in particular stocks or shares. Then we have got mutual societies. Now, mutual societies, what they do, they were very famous in the 1800s. The phenomena behind mutual societies is very interesting. What they do actually, it is formed by a number of members. They do not have a shareholder. What they do is pool their funds together or start depositing a small amount of their income into those funds. Now, that fund is used to do investment in other businesses, so that fund is utilized or is expanded. Now, if any one of those members who initially formed this society gets into the financial difficulty or retires, he or she will start to obtain funds from this from mutual society on a monthly basis so that they can carry on. Mutual society does not offer dividends. They are not made up of like a shareholder company. They are basically formed and being organized by its members. Then we've got institutional investors such as pension funds and investment funds. Now we all know what pension funds do. They take a small portion from your salary or monthly. They require you to deposit a certain amount monthly, and when you get retired after 25 years or 20 years or 30 years, depending upon the arrangement with the pension fund, they either give you the full amount which you have invested in them plus the return which that amount has generated for you and deposited into your account, or either you get a monthly like a salary or like a pension in your account so that you can carry on. Then we have excuse me, investment funds. Now, investment funds do mostly the same thing. They take money from the savings of the people and they invest it in stocks and debt instruments and other financial instruments so that they can increase their wealth. Now we've got benefits of financial intermediation. Excuse me. Now we've got benefits of financial intermediation. Firstly, it offers a convenient way for lenders to save money. Then we have got a ready source of funds to borrowers even when money is in short supply. Even when money is difficult to obtain from people, the bank will always have a large reserve to support or to give loans to the businesses when they are needed. Then we have got aggregate small savings lending to borrowers in larger amounts. What they do is, for example, a company requires $1 million in loan. It's quite obvious that not a lot of people have $1 million in their bank account. So instead of getting a dollar or loan of $1 million directly from an individual, it gets a loan from the bank. Now, bank does not obtain $1 million from one single party. It has got a number of people having their bank accounts in their bank. So it's a collection, it's a pool of funds all together, and they create a single instrument, a single loan agreement, and give it to the personal companies that requires those funds. Then we have got financial institutions. Then we got a risk for individual lenders is reduced by pooling losses are borne by intermediary and shared among lenders in general. Now, even if the lender gets defaulted or is unable to pay its debt or is liquidated, so what happens next is the people who have their account in the bank or do not get affected by it, the worst case scenario which they can face is they get the reduced rate of return which they expected otherwise. Other than that, their principal amount stays safe. So in this way, there is no risk borne by the people who deposit their money in the banks. Then we have got financial institutions offer diversified portfolios covering a varied range of different securities. Now, different providers of finance have different risk appetite. They have a number of instruments or schemes available for the investors to invest in. Now, financial institutions, what they do is they cater the need of the depositor or the person who is willing to invest their funds. They have a lot of instruments. There are a lot of arrangements available at their disposal to satisfy the risk appetite of the providers of finance. Then we have got point number 6. They provide maturity transformation, i.e. gap between lenders' wish of liquidity and desire of borrow for long-term loans. Maturity transformation, basically the gap between lenders who wish for liquidity and desire for borrowing or long-term debts. That's as simple as that. Then we have got financial markets. Now, in order to understand financial markets, you firstly need to understand what actually is a market. Market is basically a point of exchange. Now, what happens here is that markets, when you go on to a supermarket to buy a bottle of shampoo, you pay at the counter and take the bottle with you. Now, that point, the point of exchange, the point at which you gave your money in exchange for the shampoo bottle is called a market for that shampoo. Now, in this case, that market is basically a supermarket, so we can say that it's a shampoo market, or the supermarket is a part of a market of a shampoo market. So that's basically a market. Then let's move on to the financial market. Now, financial markets are markets where individuals with surplus funds lend funds to other individuals and organizations that want to borrow. It's a type of direct finance between lenders, savers, borrowers, or spenders. Now, these channeling of funds results in economic efficiency, as savers are not always the people who have good investment opportunities. Now, financial markets act more like an intermediary, but instead of creating a lot of chain of people through which the money is handed over to the ultimate user of finance, it links directly those with surplus funds to those with the people who are in fund deficit. It creates a platform through which they interact directly and provide the funds directly to them. That's the main function of financial market. Now, there are a number of markets. If you look at the chart underneath it, it's a type of markets chart. We use a lot of terminologies when we address a market. However, the fundamentals behind what actually we are talking about is basically a point of exchange for financials. That is, either we are obtaining a share for money, shares against the money, either we are obtaining a debt instrument against the money, either we are getting other financial instruments against the money that we are willing to provide for those shares or instruments. First, you got a primary market. Now, primary market is basically a capital market where new securities are issued and sold to investors. Now, if a company is being listed for the very first time, for example, an XYZ company is going to be listed for very first time to New York Stock Exchange. Now, for that company, the XYZ company, the New York Stock Exchange will be the primary market, because it's using that market for the very first time to obtain the finance. Is issuing its securities for the very first time. Then we have got interbank market. Now, bank lend short-term funds with each other. The basic rate is set by the central banks. However, they lend with each other or borrow with each other on their own specific terms, which is obviously above the base rate which the state bank has set for them. Then we have got so again the point here, what is the market? The point of exchange. When we say that the banks are exchanging the money for the liability being recognized, so what they get, that market is called an interbank market. Then we have got a euro currency market. Now, bank lends and borrows in foreign currencies as well. So whenever bank lend and borrows in foreign currency with each other, that market is called euro currency market. Don't get confused with the name. Euro currency does not necessarily mean that borrowings will be in euros. It could be in Japanese yen for all it cares. Euro currency involves basically the word is used to explain that the borrowing is done not in the currency format which is its own origin. That is, a company or a bank is borrowing. In this case, a bank is borrowing Although it is established in UK, its main currency is in UK pounds, but now it's borrowing in dollars, for example, and it's called, so that loan which is borrowing in dollars will be called a euro currency loan. So that's the basically the term which we use for the loans that is obtained in foreign currency, where that is the currency which is not the one in which it normally operates in. Then we have got certificate of deposit market, market for trading of certificate of deposits, negotiable instrument acknowledging deposit. We deposit the fund, and now that for you can say certificate of deposit, that that certificate indicates the principal amount and the return that you'll be getting from it. And now that bond is, or you can say certificate of deposit, is tradable in the market. It goes up and down depending upon the market conditions. Then we have got local authority markets. Local authorities, when they are in dire need, borrow funds, short-term funds, by issuing and selling short-term debt instruments in the markets. So that markets pertaining to the issuing of short-term debt instruments related to, you can say, local authority, it's called a local authority market. Then we have got finance house market, dealing in short-term loans raised from money markets by finance houses. That's a finance house market. Intercompany markets, direct short-term lending between treasury departments of large companies, commercial papers, that is the end bills are used for that. So intercompany, when companies borrow or lend directly to each other instead of using a bank as an intermediary, they directly, for example, I go to another company who shared a similar vision with me and ask them to fund me so that I can expand. Instead of going through an intermediary, which is a lot of hassle, they can offer to grant me directly the loan. Obviously the terms and conditions will be according to the provider of finance, because it has the upper hand. So that market, that point of exchange, where we exchange liability against the funds being given to us, is called an intercompany market. Then we have got capital markets and money markets. Money markets are quite swift and volatile. It can change, they change it with seconds. So money markets are markets for trading short-term financial instruments and short-term lending and borrowing. If you require funding and if you want to trade your currencies, so that's the market for you, money markets. However, capital markets are markets for trading long-term financial instruments such as equities and corporate bonds. Now equities provides return on quarterly basis or half-yearly basis or annual basis, whereas bonds also provide return on annual basis. So they are used as a long-term source of finance rather than a short-term. Then we have got a types of markets in UK. In UK, principal markets are the stock exchange, the main market, or companies with full stock market listing, where the listed entities shares are being sold and bought all the time. Then we got the more loosely regulated second tier alternative investment market, or AIM, as well, just for the sake of knowledge. Then we got ways to obtain funds. Now here here what we are saying, that they may raise the share capital by inviting investors to take on equity stake in the company or to increase their existing equity stake. Basically here the they means company. When the company wants to obtain finance or obtain funds, what they do, they go to the financial houses, or if they are going to the stock exchange for the first time, they have to go where a financial houses as an IPO. They invest their funds, they obtain the listing through which they start giving their shares out and start receiving the funds. And if that company is already listed, so all it has to do is to issue additional shares from its authorized share capital and gain additional finance. Now, the companies may raise debt capital as well, such as loan notes, corporate bonds, or convertible bonds. These are different types of bonds. We will be learning about also the financial instruments in the finance part of the lectures as well, business finance part of the lectures. So basically, what they do is they issue loan notes. A loan note is basically they take the money, for example, $100 from you, give you the certificate in which it is written that this is the amount that you'll be getting after the end of the year, and with it's also you can say it's on it. There's also mentioning of the interest rate which that instrument will earn you, for example 9%. So at the end of the year, what you will be getting is 109. That's the amount which you'll be getting on depositing $100 now on buying that bond or that loan note from the stock exchange. Then we got primary and secondary markets. Now, primary markets enable organizations to raise new finance by issuing new shares or new bonds. As I've just told you, if you're going to an IPO or through a finance or brokerage house, that's in this case, since you're using the stock exchange for the very first time, that's your primary market. Secondary markets enable investors to buy and sell existing investments to each other. Now that I have bought the shares and I have the portfolio, and after some time I realize that I want to sell those. Now they have gained value and I want to sell that. So I again go to the stock exchange and sell my share to some other person who is willing to buy those shares. This operation is nowadays is done electronically, so you can do that with the comfort of your home. Then we've got exchange traded instruments and over the counter markets. Now, secondary markets for financial instruments can be organized on exchanges. Normally all sorts of secondary markets are exchanges such as London Stock Exchange, New York Stock Exchange, the London International Futures and Options Exchange. Then we've got alternate second-tier markets which can operate over the counter, where customers negotiate individual transactions, usually with an intermediary instead of an exchange. Instead of going to the exchange, what they do is, if I want to get a forward contract, I would rather go to a bank, and instead of buying futures from the store, from the financial futures and options exchange market, I will rather go to a bank and fix my future transaction rate in foreign currency. That's over the counter. It's customizable. They will offer the contract according to my needs. There will be no fixed contracts with or fixed term rules being imposed on me. Then we've got institutional investors. Now, institutional investors are institutions who have large amount of funds available to them, such as pension funds. So most companies, what they do is, instead of offering their shares to a wider public, they issue their shares to a couple of institutional investors such as pension funds and insurance fund providers, so that their portfolio is not widely spread. Now these funds, these funds invest in shares or bonds that offer satisfactory returns and securities or lend it to the companies. Example, institutional investors are pension funds, insurance companies, and investment trusts. Venture capital organizations are also institutional investors because they have large amounts of money. Then we have got our next topic, that is securitization. Securitization is basically if in the clear terms, I would say is basically uh, using those funds that are locked in your fixed assets or non-current assets. If you look at the definition, it's the process of converting illiquid assets into marketable securities. These securities are backed by specific asset and are normally called asset-backed securities. Now, let's suppose there is a textile factory, and we have got a plant to make cloth. Now the company intends to expand. Either it could go to the bank to obtain the loan, or it can issue its shares in the market, the stock market, which I've just told you about. Or what it can do, it either can go to the bank and turn on the securitization. It can use its plants as a security to obtain the finance. It's basically in this way the asset of substantial value, the plant of substantial value, and the money tied in that in those assets is obtained by the company to utilize in its expansion. That money is now not locked in that. However, the liability of payment of principal and the interest stands over here, rises over here, and which obviously needs to be satisfied. So in the process of, now I'm repeating the definition again, the process of converting illiquid assets into marketable securities. These securities are backed by specific assets such as that's why they are called asset-backed securities. Then we've got mortgage bond example. It's the most common type of security, and one of the reasons of financial crisis in 2008 were. What happens basically over here is that banks, the people who obtain loan from the banks, means that they have to return the principal amount, the amount which they have borrowed, and also the interest pertaining those amount. They have to return the principal amount and also the interest pertaining to the borrowing of that amount. So, an insecurity, since they are using those funds to buy a house, the house itself becomes a security in this process. Now, the thing over here is that these funds being obtained by the people are for a huge amount of time, like 25 years to 30 years. So, for all those years, the bank's money gets stuck on those loans. So what bank had a very clever idea. What it started to do is start pooling those loans together, created an instrument or mortgage bond and sold it to the institutional investor. For example, it pooled 100 loans together into a single bond and sold it to the institutional investor. In this way, now the institutional investor basically has the right to obtain the principal and the finance because it has paid for that bond immediately to the bank. The bank has immediate source of fund which it can use again to give it to obtain, or if it has an opportunity to use it over there. Now the principal and the interest is paid by the people to the bank only, but bank, instead of becoming an asset in the bank statement of financial position, it becomes a liability because it has to pay this amount as it is to the institutional investor or to the mortgage bond holder. That's how mortgage bond was made. Then we have got disintermediation. Now, because of the securitization, this has led to the disintermediation, which is defined as a decline in traditional deposit and lending relationship between banks and the customers, and an increase in direct relationship between the ultimate supplier and the users of finance. Disintermediation is basically the removal of intermediaries from the systems of the people who are willing to give to the funds and the people who want to receive it, who are in dire need to obtain those funds. Then let's have a look at an international markets as well. Now, international money and capital markets. First thing, we have got a euro currency market. Now, euro currency is a currency which is held by individuals and institutions outside the currency of issue of that currency. For example, I'm in the UK and have a currency of let's suppose $10,000 with me right now. So what I'll be holding is a euro currency. Again, over here I need to remind you that euro currency, don't get confused with the term. Euro currency does not necessarily mean that the loan will be in euros. It can be of any currency, but will be different from the currency from your home currency. So when a company borrows in foreign currency, that loan is called euro loan. Now, it must have struck in your mind there must be an euro equity as well. For your sake, there is. We'll be discussing about that as well. Firstly, let's continue with the euro currency markets. Euro currency markets involve the depositing of funds with a bank outside the country of the currency in which the funds are denominated and relending these funds for a fairly short term, typically 3 months. What they do is actually in euro currency markets, they deposit funds with a bank outside the country, not in their own country. For example, they deposit the company will deposit the fund not in UK but in the USA, and they gain from this by relending it, or if they want to invest over there in a portfolio, they can either borrow the loan from those foreign banks. In this case, it will be a euro loan. Then we have got international bond market. Well, it's a different thing. International bond market is basically a euro bond market or bond denominated in a currency which often differs from that of the country of issue. For example, Malaysia wants to issue euro bonds. It will issue the euro bond in dollars, not in Malaysian dollars but in US dollars. So here the bond is called euro bond because it differs from the currency in which it basically operates in. The euro bond, I'm reading it again. A euro bond is a bond denominated in a currency which differs from the from that of the country of issue. There is also less highly developed market in the international or equity shares market, as I've just told you in the last topic, that there is an equity market, but unlike debt instruments which are backed by securities, equity is not backed by securities. They are simply being issued by the companies, and the share and the people who hold them have the right to say in the voting rights, and also have the right to return, right, to obtain the returns from the profits. So they are not backed by an asset, so they are highly risky when compared to the debt instrument. That's why there is a market, a euro market, an international bond market, but there is an equity market, but unlike bond market, it's not very popular. Then we have got euro bond, are basically long-term loans, are between 10 to 15 years, raised by international companies. Big companies only can issue euro bonds like Unilever or P&G, and sold it to investors in several countries at the same time. Now they can issue euro bond, and what they do is spread those bonds across different exchanges, so they appear on different exchanges with the same base currency. For example, a company from Europe intends to obtain a euro bond. What they do is that they go to the exchanges and start dispersing the euro bonds. The euro bond, just for the sake of simplicity, the euro bonds will start to appear on the screens of different exchanges across the world. Now the base currency will be not in euros but in dollars, since it's the euro bond. So it will be in dollars or any other currency which they seems fairly enough. So that's how it spreads out. Eurobonds may be more suitable for multinational companies which require long-term loan to finance a big capital expansion program in any country, for example. So basically, these bonds are not issued for 1 or 2 years. They will at least be of 10 years or at least a minimum of 5 years, not below that. Then we requires borrowings which are not subject to national exchange control of any government. So the borrowings which they will be getting from offering a Eurobond are not subject, since they are not issued to any one country or specific country. So no law of any specific country can affect it. There is no regulations in most of the countries across the world about Eurobonds. So they do not get regulated. They are not subject to the regulation by the government. Then we have got an investor subscribing the bond issue will be concerned about the following factors. Number one is security. What is the security behind it? They will be concerned about, since they are investing to a completely blank area. As I've just told you, they are not very much regulated, so they will be highly interested what is given by the bond issuer. Then we have got marketability, whether those bonds will have a marketability. Will normally it's a yes, because they are sold and bought simultaneously across the exchanges on the world, so they have a marketability. But still they will look at this factor. Then we have got anonymity. Now Eurobonds are issued under bearer's name, so if you lose the document, the bond document, there will be no trace that you actually hold it. There is no regulation, no track record. The company could simply deny it, and since, as I've just told you, they are not regulated, so there's nothing which you can do about it. And that's why Eurobond is one of the favorite mechanisms of the black economy or the money launderers across the world. Then we have got the return on investment. Obviously, with all this into account, the return is quite good, above the normal return that you would get from a normal bond. So let's keep it here.